Welcome back to the Indicator Library. Today we're covering one of the most important and most misunderstood tools in trading: volume. Most traders focus entirely on price. But price tells you direction. Volume tells you conviction. Volume shows how much participation is behind a move. And without participation, price movement can be weak, fragile, and short-lived. In this video, we'll break down what volume actually represents, why rising price without volume can be dangerous, how volume confirms breakouts, volume during reversals, high volume spikes, and how to combine volume with structure. Let's begin. Volume simply measures how many shares, contracts, or units were traded during a specific period. Each volume bar represents total activity during that candle. High volume means heavy participation. Low volume means limited interest. Volume does not tell you direction. It tells you strength behind movement. Now let's address something very important. Volume is not the same as momentum. And understanding the difference changes how you use both. Momentum indicators, like RSI or MACD, measure the speed and acceleration of price movement. They tell you how quickly price is moving and whether that movement is strengthening or weakening. Volume, however, measures participation. It tells you how many participants are involved in that movement. Think of it like this. Momentum tells you how fast the car is moving. Volume tells you how many people are inside the car pushing it. You can have strong momentum with low volume. That often means a move is happening quickly, but without broad participation. Those moves can be fragile. You can also have rising volume with weak momentum. That may indicate absorption, heavy trading without strong directional movement, which often happens during accumulation or distribution phases. Now let's talk about how volume works with other indicators. If MACD shows bullish acceleration and volume is expanding, that's stronger confirmation. If RSI shows bullish momentum and volume increases during the breakout, that adds conviction. But if RSI is overbought, MACD is extended, and volume begins declining, momentum is slowing and participation is fading, that's a warning sign. Here's the key principle. Momentum tells you how strong price is moving. Volume tells you how supported that movement is. When both align, probability increases. When they diverge, caution increases. For example, price breaks resistance. MACD crosses bullish. RSI pushes above 50, but volume remains flat. That breakout may lack participation. Now compare that to price breaks resistance. MACD accelerates upward. RSI strengthens. Volume spikes. Now structure, momentum, and participation align. That's layered confirmation. So volume should not replace momentum indicators. And momentum indicators should not replace volume. They measure different dimensions of market behavior. When combined properly, they create a more complete picture. There are 4 core price-volume relationships. Price up plus volume up, strong move. Price up plus volume down, weakening move. Price down plus volume up, strong selling pressure. Price down plus volume down, weak decline. The key principle: strong trends are supported by increasing volume. Weak trends are supported by declining volume. Volume is extremely important during breakouts. If price breaks above resistance with low volume, that breakout may fail. But if price breaks resistance with a volume spike, participation is expanding. More buyers are entering. That breakout has strength. In strong trends, pullbacks often happen on lower volume. Why? Because the dominant side, buyers in an uptrend, are not aggressively exiting. But if a pullback happens with increasing volume, that may signal deeper correction. Sometimes you'll see extreme volume spikes. These often happen near breakouts, news events, trend exhaustion. Climax volume at the top of a move can signal distribution. Climax volume at the bottom can signal capitulation. But context is critical. If price continues rising, but volume gradually declines, momentum may be fading. This is volume divergence. It doesn't guarantee reversal, but it warns of weakening participation. During consolidation, volume often contracts. When volume expands again, that expansion often precedes the next directional move. Volume should never replace structure. Structure tells you where price is. Volume tells you how strong the move is. For example, uptrend, pullback into support, bullish candle forms, volume increases. Now, structure and participation align. That's confirmation. Common mistakes include trading volume spikes without structure, ignoring low volume breakouts, assuming high volume always means bullish. Volume measures activity, not direction. Context matters. A structured volume approach looks like this. Step 1. Define trend. Step 2. Wait for pullback. Step 3. Look for expansion in volume during breakout. Participation confirms direction. Hi, I'm Indy. So let's summarize. Volume measures participation. Strong trends expand volume. Healthy pullbacks contract volume. Breakouts need volume confirmation. Price without volume can be fragile. But when structure and participation align, probability improves. If this helped clarify things for you, make sure you subscribe and explore the rest of the indicator library. We're building real understanding here, step by step, and I'll see you in the next one.